Hi, everyone. Thank you for joining us today for our webinar. This is Jessica Wilson with Provada. Our webinar today is titled Understanding Today's Long-Term Care Solutions, which will be presented by Bob Burton, our Director of Advanced Planning at Provada. If you have any questions during the session, please be sure to type them in the chat window. And with that, I will now turn things over to Bob.
Thank you very much, Jessica, and I'm delighted to be here to present this webinar for you today. Long-term care is one of the burgeoning insurance fields, and it's very important that all of us be well-equipped to make good sales in this field. And I want to make clear that that is our sole and only purpose today, is to help you make more sales in the long-term care area, and of course, sales in any area open the door to sales in all areas. I think it's clear today that there is a recognized growing need for long-term care insurance. People recognize it all the time. It's a major subject of discussion. There's a lot of legislation about it, and so it behooves us today to learn about it, as not to become experts, but to know enough to be able to get out into the marketplace and make good, solid sales. Fortunately, Provada has powerful solutions that will help you make sales to your clients, and that is your goal, and that is our goal. So let's see what we can do to help you in that regard. I think one of the problem areas in the sale of any form of insurance, and particularly perhaps in the field of long-term care insurance, is finding the premium dollars. People acknowledge that they need the coverage, but they have a tough time coming up with the premium dollars. And that's particularly true in today's rather difficult economic times. So what we want to do today is to help you protect your clients by enabling them to purchase long-term care insurance on a favorable basis, and this will drive large insurance sales for you at the same time. So that is our goal. Let's look forward. We're here to work with you and for you to work with us to identify your clients and to present long-term care solutions. It's one of our stronger products. We have many strong products, of course. Life, disability, annuities, and long-term care is clearly one of them. And we do a lot of business in that field, and we have some very, very good carriers. And I think we have the right solutions that will help you. Fortunately, today, there are several different ways that you can provide long-term care coverage for your clients. This wasn't always true, but it's becoming more and more true all the time because of the recognized need for coverage. More and more types of coverage are being developed. There is, of course, traditional standalone long-term care. This is the traditional policy that's been around for, perhaps 20 to 25 years, although has gotten much more refined in later years. This is simply a policy that provides long-term care benefits and no other benefits. And one of the big objections that a lot of people have to this is that if they never need care, they have spent a lot of money and it goes down the drain. And people don't like to see their money going down the drain. Of course, it's really no different from automobile insurance. We hope you never have an automobile accident or need the coverage, but you wouldn't be without it. Homeowners insurance. We certainly hope your home is never burglarized or never burns down, but you wouldn't be without it. Liability coverage, in case you do something that seriously injures somebody else. You don't want to be responsible without insurance coverage, but of course, we hope that never occurs. The same thing is true with long-term care insurance. We hope you never need it. Nobody likes to be in a position where they have to collect, but it provides valuable protection, and I think nobody should be without it if they can possibly get it. It's a very important type of policy, and it buys peace of mind, just like those other coverages. These standalone policies also happen to be the most flexible product on the marketplace, and with the various options you can put together, they usually provide the best coverage. So let's look at some of the others to see what we're talking about. Another type of coverage that's become quite popular is a regular life insurance policy that has a long-term care rider added to it. There aren't a lot of carriers that have that, but those that do, the two primary ones are John Hancock and Nationwide, both excellent carriers. and the rider can be added to most of their policies. I want to make it clear that it's still a just straightforward life insurance policy, and this is a rider that you can add or not add at your own option. And we will be looking at that further later. One of the benefits, of course, is that someone will always get paid. If you don't use the long-term care benefits while you're alive, then the full death benefit will be paid. If you use some of your long-term care benefits, then the remaining will be paid as a death benefit. These products best fit those who really want both life insurance and long-term care coverage. But it is also an answer to those who say, I don't want my money to go down the drain. I would like to make sure that somebody gets a benefit somewhere along the line. The newest type of products, although some of them have been around for a while, are hybrid or linked benefit policies, which are different from the life with long-term care rider, which, as I said, is really a straight ordinary life insurance policy with a rider that you could add or not at your own choosing. These are policies that are built to function as a unit, and so the benefits are linked. You cannot buy these for one benefit or the other. The two main types are life and long-term care combinations and annuity and long-term care combinations. We're not going to deal with the last of these because we had a webinar on this a couple of weeks ago put on by State Life, which is available on our website, and I encourage you, if you haven't already listened to that, to do so. But we are going to talk about all of these other available options. All of these hybrid and linked benefit policies were given a strong boost by the Pension Protection Act of 2006, a number of whose provisions did not become effective until January 1 of this year. And those provisions primarily related to long-term care benefits and how to pay for them on a tax-favored basis. Interesting that in the Pension Protection Act, long-term care was considered important enough to incorporate these provisions. But they wanted to give time for the carriers to be able to adjust and prepare for it. One of the primary benefits incorporated into this law is to permit Section 1035 tax-free exchanges into policies that provide long-term care benefits. We've known about Section 1035 tax-free exchanges for many years, but they usually applied only from a life policy to a life policy, from a life policy to an annuity, from an annuity to an annuity. Endowments were thrown in there too as life policies, but those were the basic things. Now you can do it also from any kind of policy into a policy that provides long-term care benefits, and that can have significant tax advantages, as we will see. And one of the benefits is that it now even includes the ability to do partial 1035 exchanges, which means that you could often exchange, for example, we will not talk about this in detail, but little pieces of existing deferred annuities into a regular long-term care contract and help pay for it over the years. So it's important to understand these provisions in the Pension Protection Act. So with that background, with that introduction, we're going to look at three powerful sales ideas that you can use in the long-term care market. The first goes back to the traditional type of coverage, a standalone long-term care policy. But one of the best marketplaces to talk about that kind of policy is to a middle-aged couple, because that's where the prices are still attractive, but they're old enough to understand the need. And particularly those who, from experience, probably with a parent, certainly understand the need for long-term care insurance because they've seen what can happen in those cases with no coverage. Let's look at this particular example that I picked rather arbitrarily, and I did this in Florida, although I could have done it in any state. Different states have somewhat different policies and slightly different benefits sometimes, but this is rather typical. I arbitrarily picked a couple, ages 60 and 58, and these are gender-neutral policies. They're not sex-distinct. Let's assume here that the husband is a smoker, so he will get a standard rate, but that the wife is a healthy non-smoker who will be preferred. Again, I just made some arbitrary assumptions to see where it would come out. At the bottom of this page, I indicate kind of what the benefit structure is. First of all, the particular policy provides benefits on a monthly basis, so the monthly long-term care benefit today is $6,100 a month. That's really $200 a day, but since there are a little more than 30 days in the average month, of course, there is no day that has a little over 30. It's either 30, 31, or 28, 29 once in a while. But use 6,100. And I had an elimination period of 90 days, but 0 home days for home care. And that's a very important benefit, since I think most people would prefer to stay at home to get their care, certainly at the beginning. And one of the great benefits is that in many cases, when you receive let me backtrack. That benefit comes automatically attached to some companies' policies. The original Genworth policies were that way, and they're still in many cases true. But all carriers now just about allow you to add that benefit at a slight additional cost, and I strongly urge it, because in most cases, every day of care you receive at home counts towards the 90-day elimination period. So if you start your care at home, you stay home at least 3 months, you will have satisfied your elimination period for all purposes. And so the use of that rider means you don't have to elect a shorter elimination period. I also, rather arbitrarily, picked a 6-year benefit period. That seems to be a common one in the 5 to 6 year range. Ideally, I like to see unlimited benefits, but I didn't want to overload this one. And this particular policy comes with a survivorship benefit. In some states, it's a 10-year survivorship benefit. In others, it's 7. And basically, that means that if the coverage is in existence on both spouses without claim for a certain period of time, in this case 7 years, and one of them subsequently dies, then the premiums are waived for the survivor. You can look at the details of that in any of the policies. I also included a 5% compound growth factor on this benefit. I think that's extremely important. And I would rather start, in fact, with a lower initial benefit to have it grow at 5% compound, because if someone could qualify today for a policy like this, the chances of their needing care in the next 5, 10, or 15 years are relatively small. They're most likely to need care in the years in the future. And this increased factor, a 5% compound here, kicks in immediately. At the end of the first year, the benefits of the pool of money go up by 5%. And that goes on every year, both before you're on claim and while you're on claim. So right now, as I indicated before, with this kind of package, the monthly benefit is $6,100. And the maximum pool of money that you could collect today is $439,200. That's a rather easy calculation, because this is a monthly benefit of $6,100. There are 12 months in the year, so you multiply 6,100 times 12. That becomes the annual benefit, and it's for 6 years, so you multiply then by 6, and that brings it up to the $439,200. Now, as I indicated, both of those numbers go up 5% compounded year by year. So I just picked some typical years down the road to see what those benefits would look like. In year 15, your $6,100 has grown to over $12,000, and your $439,000 pot of money has grown to $869,000. By the 30th year, and by the way, it's between 15 and 30 that you'll be likely to collecting benefits, your monthly benefit is now up to over $25,000, and your total pot of money is over $1.8 million. Rather impressive, I think you'll agree. The total combined annual premium, including the spousal discount and for the wife, the preferred health discount, is just a little over $6,400. That's shown at the bottom of the page. If that seems steep to a particular couple you're dealing with, and particularly with the 5% compound increase factor, if you cut this benefit down by a quarter, roughly, to say $4,500 a month, that would cut the premium by a quarter too, as well. And so you'd be down to something in the neighborhood of $4,800 a year, which is much, I think, sounds a lot better. That's still a great sale, I think, for the benefits and the peace of mind that the amount of money that it costs is really quite manageable and quite modest.